Hello and welcome to our session on the principles of crowd investing. In this session, we are going to learn about the characteristics of crowd investing. Where can crowd investing be found in the FinTech market? The FinTech market is divided into the segments account and payments, financing, investment, and services and tools. Crowdfunding is located in the FinTech segment financing because the financing of projects, private or corporate clients, is done by a large number of people, the so-called crowd, who are recruited as investors via the internet. Let's dive deeper into the crowdfunding subcategory. The subcategory crowdfunding is divided into profit-oriented, online alternative finance, and non-profit-oriented, online alternative finance. Crowd investing is found in the profit-oriented online alternative finance segment because investors receive a financial return on their investment in startups. What is crowd investing? Crowd investing is the brokering of capital via an internet platform for the purpose of financing an existing company, a company in the process of being founded, or a company to be founded. This can be done with or without the investor's right to repayment of the amounts and in return for a reward, the main component of which is either an interest payment dependent on business performance or a silent participation in the company receiving the capital. Due to regulation in Germany, most of private investors acquire a stake in the company in the form of a share-like agreement, as notary fees are very high. Within crowd investing, a further distinction is made between lending-based crowd investing and equity-based crowd investing. Lending-based crowd investing is the participation in the company with debt capital, possibly equity-like mezzanine capital. The most important mezzanine financial instrument is the subordinated profit participating loan, in which investors participate proportionally in the company's profits without receiving the rights associated with an equity investment, such as voting rights. Equity-based crowd investing refers to the sale of equity interests in companies in the form of a silent partnership. A silent partnership is a virtual participation in the establishment of the company and is imitated by contract law. Investors have two different options for investing in startups. The first investment option is direct investment in a startup. The second investment option is an indirect investment, also known as a pooled investment. This investment in a financial vehicle collects all the financial contributions from the crowd and then invests the entire amount in the startup as an individual shareholder. The trustee of the financial vehicle manages the collected money on behalf of the crowd and pays claims from the contracts back to the investors. In the European Union and the United States, crowd investing is often impacted by regulation in the platform's country. Two models are common in crowd investing: the first come, first served method and the auction mechanism. In the first come, first served approach, founders set a total funding limit and stop selling securities to the crowd when the limit is reached. In the auction mechanism, investors can make commitments by specifying the number of lots they want to buy and the price they are willing to pay for each lot. For this purpose, the portal and the startup set a lower limit for the price of a single lot. In the first phase of the auction, everyone who has paid money gets the desired number of lots, and the lowest price applies to everyone. Therefore, there is no reason for investors to overbid the lower limit unless they want to avoid the transaction costs of bidding again later. The second phase of the auction begins when a predetermined number of investment tickets have been allocated to the crowd. The number of tickets and thus the start of the second phase of the auction are not known to the investors until all tickets have been allocated. In this phase, the number of tickets is kept constant and investors can outbid each other with higher prices. It is important to know that the second phase is not limited to the investors of the first phase. Everyone who is registered on the portal can continue to bid. The second phase lasts until the funding limit is reached. The third and final phase of the auction begins as soon as the previously set funding limit is reached. In this phase, investors can still outbid each other. However, it is then no longer possible to increase the total amount. Higher bids therefore lead to a reduction in the total number of tickets and thus to a reduction in the number of investments that a startup has to sell for a certain amount of capital. In practice, only a few campaigns reached the third phase of the auction, while all other campaigns ended before reaching the third or even second phase. The choice of market mechanism likely affects the dynamics of investor behavior during the campaign. For example, because prices remain constant under the FCFS mechanism, investors have no incentive to withhold their bids and can bid early to maximize their chances of acquiring securities. In an auction mechanism, investors may prefer to wait until the end to avoid revealing their interest in buying securities, which could lead to higher demand. In this case, there may be a stronger end effect that shifts to the momentum of individual investments toward the end of the campaign. On this slide, we go into more detail about the advantages and disadvantages of crowd investing. The biggest advantage for investors is the ease or the comprehensiveness of comparing early financing options. In addition, many crowd investing platforms allow the placement of small amounts of investment, opening up the world of venture capital investing to small investors. Crowd investing platforms provide standardized financial contracts and perform due diligence on startups with the help of experts. However, there are also some disadvantages. Due to financial instruments structured as mezzanine capital, investors have no influence on the company's business decisions. Through the direct or indirect investment options, the investors may be affected by the insolvency of the startup and suffer a total loss of their investment. Furthermore, it is difficult to sell the financial instruments on a secondary market, as these investments may be unattractive for many other investors. To summarize the presentation, keep 3 points in mind. One very important fact is that private investors acquire a stake in the company in the form of a subordinated profit participating loan or silent partnership, but not a stake in the equity of a company. This means that the investors have a pro rata share in the profits of the company, but they do not have voting rights. The second argument refers to the various investment opportunities that can be made directly or indirectly through syndicates or venture funds. The last argument refers to the allocation of shares. Two different mechanisms are used here. One is the first come, first served method, and the other is the auction mechanism.